All right, good morning, everyone. It looks like we have a lot of participants on, so I think we're ready to get started. Thank you for joining us. My name is Shelly Harris, and I'm an associate attorney in the estate planning practice here at Williams-Mullen. Today, I'm going to address how cryptocurrency and blockchain technology intersect with estate planning for tax and gifting purposes. I'm also going to give a few examples of how blockchain technology and crypto are affecting the life insurance industry, because it's just a good way to look at how those technologies work together. And finally, towards the end, I'm going to go through a few recent developments in the world of cryptocurrency and blockchain technology. That'll be towards the end of the presentation. Just a couple of housekeeping notes before we get started. I encourage you to ask your questions throughout the program using the Q&A feature that's on the bottom of your screen. I will answer questions at the end of the presentation, time permitting. Also, a copy of the presentation slides will be emailed to you later today. So let's go ahead and get started with the program. All right, whoops. Okay, so this is the title of the presentation. That's me when my hair was straighter. And here's the questions. I already went through all of that. Okay, so part one, I'm just going to kind of go through some definitions, some terms, so we can all be on the same footing about what exactly cryptocurrency is, what is blockchain technology, what's the difference. I'll preface this by saying that I'm an estate planning lawyer, not a cryptocurrency expert. Definitely could not develop blockchain to save my life. I don't code. I don't own a giant mining computer like we'll be talking about soon. These are just things that I've learned so that I could be able to apply them in the estate planning context. So please don't consider me an expert in these technologies, but I can give you hopefully a good overview. So the definition of cryptocurrency, this is actually from the dictionary. It was included in the Merriam-Webster version of the dictionary in 2018. So as you can see, this is pretty cutting edge stuff and it's changing all the time, but this is the most current definition. Cryptocurrency is any form of currency that only exists digitally, that usually has no central issuing or regulating authority, but instead uses a decentralized system to record transactions and manage the issuance of new units, and that relies on cryptography to prevent counterfeiting and fraudulent transactions. So a big part of that is decentralized. We'll talk more about what that means for this kind of currency in a minute. And it also relies on cryptography, which we'll talk about more in a minute as well. So what is blockchain technology? Well, blockchain is also called distributed ledger technology. It's a system where records of transactions are established across various computers, all of which are linked in a peer-to-peer, or as the kids say nowadays, apparently P2P network that uses an agreed upon set of rules, which is called a protocol. The decentralized ledger means that each node in the chain is responsible for verification according to the protocol. So I will get into more about the details of how that works and show you a couple of examples in a few minutes. A basic point to understand right now is that instead of a centralized authority that verifies the authenticity of transactions, what we would call a centralized ledger, each user in the chain with blockchain technology and a decentralized ledger is called a node and is responsible for verification according to the protocol that's in place. So what you're really doing here is you're getting rid of kind of the middleman, which may, for example, be a bank or another kind of clearinghouse through which transactions are usually verified in a central manner. And instead, verification will occur by each node in the chain. And again, we'll look at this a little bit more closely as the presentation goes on. Blockchain is related to cryptocurrency because it's the technology that drives the creation of cryptocurrency. A lot of the time these two terms are conflated, but they are actually different. Blockchain is the technology, cryptocurrency is a product of the technology. So here's an example that I found online of a decentralized ledger or blockchain technology or non-blockchain technology versus a distributed ledger, which is using the blockchain technology. So you can see in the center on the centralized ledger, you have a clearinghouse, which may be a bank or any other centralized authority that's helping you to verify a transaction of some kind. Everyone who's participating in the transaction has to submit their information to the clearinghouse to be verified as being correct. So if you're doing some kind of online transaction, let's say you're paying with a credit card, the credit card company is going to be one of the institutions submitting information to the centralized clearinghouse, for example, a bank, to verify that your transaction was made by you as a payor and that everything's in order. On a decentralized ledger, like what you see with blockchain technology, each node in the chain is going to be verifying the authenticity of the transaction, verifying that it is an authorized transaction by adhering to a certain set of rules that governs that particular blockchain ledger. Every kind of blockchain, for example, there's a public blockchain technology that people can access called Ethereum. Every node on Ethereum has to agree to the protocol, and the protocol tells you how you're going to verify each transaction. And so that's how it's verified. You can look in the middle and see that there is no clearinghouse. Everybody's just kind of logging on and being a part of the transaction and verification rules. So just a little brief history of how cryptocurrency came about, since it's a very new kind of investment, and also because it's based on a new technology, blockchain technology. In 2008, Bitcoin was actually created by someone named Satoshi Nakamoto. Actually, we don't know who this is for sure. It's probably a pseudonym for someone or a group of persons, and it has never been verified who that is. In 2011, competitors to Bitcoin started entering the field. One of the first ones was Litecoin. That's another kind of cryptocurrency. And finally, as of 2020, there are over 2,800 cryptocurrencies in circulation. So I think we tend to think, oh, it's just Bitcoin, but there's actually a whole bunch of these around the world. Excuse me, I get hoarse when I'm talking, so I'm just gonna grab a cough drop here. I'm not sick though, I promise. Okay, so what are the main differences between cryptocurrency and fiat currency? For one thing, because we don't have a central authority with cryptocurrency, we're using that blockchain technology. We're cutting out the middleman and therefore saving transaction fees for those consumers who wish to, for example, transfer money. There are some transactional fees that are payable to miners in the blockchain, which I'll discuss more what miners are shortly, but those transaction fees are fewer in number and amount than they typically are when you're transferring fiat currency. Oh, fiat currency just means it's traditional currency, not cryptocurrency. Excuse me. Transactions involving cryptocurrency also enjoy increased security thanks to cryptography. Cryptography is very complicated coding that secures the transaction, and it also enables the removal of the central authority, that is the bank, from the chain of transactions, because everything's being verified and secured because of the cryptography. So those are the two main differences between crypto and fiat. There are there are many variations between different kinds of cryptocurrency. I know Bitcoin is the one that your mind kind of jumps to, but like I said, there's 2,800 varieties, and there is variation there. One variation is levels of decentralization. So we talked about the decentralized ledger. It can be more or less decentralized than kind of the figure I gave you. An example of a fully decentralized cryptocurrency is Bitcoin. It's completely decentralized. There is no central Bitcoin office that you can call if you have a problem, for example. Every node on the chain is pretty much independent from every other node. Centralized, it can be more or less centralized. The most centralized one is probably Facebook Libra, which you might have heard of, that Facebook is coming out with its own cryptocurrency. The protocol for Bitcoin is developed by individual nodes on the chain, individual people who are miners. Miners are the people who, and I'll get more into what that means, but miners are the people who are issuing the new Bitcoins. They're solving these cryptographic hashes so that transactions can be finalized. If a miner feels like a new change in the protocol is a good idea, he can start, suggesting it to other miners, and eventually they'll all say, yeah, I think that's a good idea. We're going to incorporate this into the protocol. Or they won't. It's pretty democratic. They'll say, nope, we're not going to verify transactions where you do that. We disagree with this change. With Facebook Libra, Facebook is going to be saying, this is the protocol, these are the rules, everybody get in line. because it is fully centralized. Stable coins, sorry, stable coins and Ripple are other examples of more centralized protocols. They're typically issued by for-profit companies. I'm gonna get a drink of water, sorry. All right. Levels of anonymity, sorry, going back for a second. Levels of anonymity also vary between one cryptocurrency and another. Monero is an example of a very anonymous cryptocurrency versus Bitcoin, which is not anonymous. So what does that mean? Does that mean that if you have a Bitcoin transaction, anybody can just look online and see your name and how much Bitcoin you traded? Not exactly, but there are levels of caution that need to be addressed here. I'm so sorry. From Bitcoin's website, this is from Bitcoin's actual website. They have a bunch of warnings on there for people who are thinking of getting involved in Bitcoin. So if they actually have warnings on there, I think we should take them pretty seriously since they're being dispelled by the website itself. So the website actually warns, some effort is required to protect your privacy with Bitcoin. All Bitcoin transactions are stored publicly and permanently on the network, which means anyone can see the balance and transactions of any Bitcoin address. However, the identity of the user behind an address remains unknown until information is revealed during a purchase or in other circumstances. This is one reason why Bitcoin addresses should only be used once. Always remember that it is your responsibility to adopt good practices in order to protect your privacy. So that's Bitcoin telling you, you need to be careful every time you do a transaction and use a different address, which they help you figure out how to do, to protect your privacy, because this is not an anonymous transaction the way that some cryptocurrencies like Monero are. So this is just an example of how cryptocurrency is developed. I thought this diagram was helpful. It just kind of leads you through a transaction that involves, for example, Bitcoin on a block or blockchain technology. So let's say in step number 1, A wants to send data to B. A is going to initiate a transaction. The message includes details about the recipient, B, who will be receiving the money or whatever is being transferred, the value, and a cryptographic digital signature providing the verifying the authenticity of the transaction. So basically, A has to answer some questions as part of the protocol in order to verify that, yes, I do want to send this amount. Once that process is completed, step 1, a blockchain node is created and authenticates the digital signature and places the transaction in a pool of pending transactions. So this is when a person who's called a miner or a company who's called a miner steps in and comes to the forefront. They are somebody who understands the protocol, has a very powerful computer that's able to solve cryptographic hashes, and is going to pool these transactions together in something that's called a block. So let's say A is initiating a transaction, so is person E, so is person F, so is person G. The miner will gather a bunch of these similar transactions into a block, an electronic block. So the node, for example, a miner, creates a block of pending transactions and broadcasts it to the network. So they've created a block, now they're putting it out on the network so other members of the decentralized ledger, for example, Ethereum or people using Bitcoin, can see that this block is available and waiting for verification. Other nodes in the network, so for example, other miners in the network, validate the block through a process called proof of work. Proof of work is the process of miners, and when I say miners, I don't mean like kids under 18, I mean M-I-N-E-R-S. They're like people, the idea is that they're kind of mining cryptocurrency out of a mine, like miners in the old days mined gold. A little bit different, but that's where the term comes from. So the proof of work process is when they're determining, they're answering this cryptographic equation, which is called a hash. It has to be solved in order for the transaction to be completed. When the miner, whichever miner solves this problem first, kind of unlocks all the transactions that are in the block and enables anybody and enables those transactions to be finalized so that the data is finally moved from A to B. Everybody can see, everyone on the block, or on the chain rather, can see the blocks as they're being verified. So that's what we mean when we say it's not necessarily anonymous, right? You can see that person A, even though it doesn't say person A is Shelly Harris, you can see that person A with their particular address has initiated this transaction, and then when it's finalized. So once the cryptographic hash is solved by a miner, the transaction can be finalized and B will receive the data or the money that's being transferred on the blockchain technology. Miners are paid a fee when they solve the cryptographic hash. So that's why they're in it, not out of the goodness of their heart, although, you know, maybe that has something to do with it. Okay, so mining, again, is how it's how new coins for cryptocurrency are introduced into circulation. And it's also how the blockchain network is secured. So mining is not a centralized process. Rather, there are a bunch of nodes on the chain. Like we talked about, some of the nodes are the people initiating the transaction, like person A. Some of the nodes are the people receiving the money or the information, like person B. But some of the nodes are these miners who are there to solve the very complex cryptographic hashes. And therefore, once they do that, they are often rewarded with new coins. So new Bitcoins, for example. So that's how new Bitcoins come into circulation. It's as payment to miners. Miners collect the various transactions on the network, like we just talked about. And then they verify the validity of all the transactions in the block and then solve that cryptographic hash. The hash can only be solved by extremely powerful computers that perform hundreds of millions of calculations per second. So you can't just use your iPhone to become a miner. You really have to invest in this thing. After the hash is solved, the block is then checked against the rules of the network's protocol. So this is where all those rules come into place. You got to make sure that person A abided by all the cryptographic rules that are required by Bitcoin or Ethereum or whatever the chain may be. Once the block has been accepted, then the hash has been solved, that everybody's verified that the protocol has been adhered to. Then the transaction is complete and the miner is rewarded by the distribution of those new coins like we talked about. So I just wanted to give you an example of what mining looks like. This is an example of one of the kind of computer fields that exist in warehouses. A lot of them are in China for solving cryptographic hash. So, I mean, you can see the little person way down at the end down there. He's a lot smaller than these computers. So it's pretty sophisticated stuff. There are people who do mining like from their home. They have pretty sophisticated computers. They're nothing like this. So those people are not going to probably be able to self-support on mining. They're just not going to be able to do the volume of work that a place like this could do. Just another helpful transaction, a helpful diagram of how these transactions occur. This one is from Bitcoin. So you can see that Rob wants to send 0.3 Bitcoins to his friend Laura. He has a Bitcoin wallet, which is a digital wallet where he stores his Bitcoin. He's going to scan or copy Laura's address, her Bitcoin address. He's going to fill the amount in. He's going to send it. In only 10 seconds, you can see that the transaction is already up. It's already been validated as being a verified transaction that Rob has initiated. The miners are going to start gathering that transaction and joining it with other transactions to be similar transactions to be a block to be mined. Next comes the mining process where various miners are kind of in a race to solve the cryptographic hash that governs that entire block. The miner who solves that proof of work, that process of determining the answer to the hash, is going to be rewarded with the new Bitcoins. And he's also going to add that block to the network. The nodes on the network, other miners, other users are going to verify that the transaction that Rob initiated here is in line with the protocol of Bitcoin. Laura is going to see on her phone that it looks like the confirmation of the transaction has gone through, and now she's got the new Bitcoins. You can see it was about 10 seconds halfway through. With a network like Bitcoin that's very sophisticated, has a lot of miners, this whole transaction is probably only going to take about 30 seconds. So all of that math is going to be occurring in 30 seconds. So pretty impressive stuff. All right. What are the advantages of cryptocurrency? Why do people choose to invest in it? Why do people want to use it? First of all, it goes back to the decentralized issue. Middlemen, like banks or clearing houses or credit card companies or what have you, charge for their services when you're transacting, and that can slow down transactions. Transaction fees that are payable to miners. So when Rob back there is initiating a transfer to Laura, when he initiates the transfer, he's going to be transferring those 0.3 bitcoins that he wanted to send to Laura. There's also going to be a small fee involved in that. So when he hits send, he's also agreeing to a fee, and that's the fee that's going to be paid to the miners who solve the cryptographic hash and add the transaction to the block. So there are fees. It's not completely free, but the fact that it's decentralized does mean that the transaction fees generally are lower. Another issue is that people worry about centralized currency authorities like the governments of the world, that they may be subject to corruption, which can make cryptocurrency especially attractive to people in destabilized countries where currency values go up and down and there's a whole lot of fluctuation, and there's concern that maybe the government isn't corruption free, we'll say. Security concerns relevant to traditional monetary transactions are rampant. People really worry about the security of their transactions, especially transactions online. Interestingly, this is a reason for cryptocurrency and a reason against it. It's all about how well this all works. If the cryptographic hash is extremely complicated, if the protocol is very rigid and tight, then the security of a transaction on a decentralized ledger can be much better than in a traditional transaction. However, it's possible that you haven't come up with a great decentralized ledger. This blockchain technology isn't really the best, and then people's security concerns are going to resurface about using this. Some populations may lack access to banking, traditional banking. There are countries in the world where people are interested in accessing the kinds of things that we take for granted here as far as our access to banking. And those countries are much more likely, people in those countries may be more likely to have an interest in cryptocurrency that they can tap into as a node on the chain without having to go through the hassle of trying to locate traditional banking services in that country. There's also the problem of quantitative easing. That's the problem of governments overprinting currency and causing inflation, which we've seen most dramatically in recent years in Venezuela. So people in countries like that may be more likely to turn to cryptocurrency as a means of sort of hedging their bets against what the government is doing as far as inflation. So why wouldn't you be interested in cryptocurrency then with all those advantages? Well, one of the problems is market volatility, and this is a big deal in Bitcoin and other cryptocurrencies. There's a lot of volatility primarily because of the newness of these assets and the fact that they have not been highly regulated. So the value of these goes up and down all over the place. So in 2017, for example, Bitcoin's price per coin climbed from $1,000 to $19,000 over just a 9-month period. And then it fell to $3,100 per coin in 2018. By December 2019, which is the first time I gave a presentation about cryptocurrency, each coin was valued at roughly $7,319. By February of 2020, it had gotten up to about $10,000 per coin. People were getting pretty amazed by the dramatic increases in the value of Bitcoin. And then in March 2020, after COVID-19 made its dramatic appearance all over the world, the value plummeted to about $5,000 per coin. So we're talking a 50% decrease in the value of each coin in a very small, like a 5-week period of time. Currently in May 2020, it's back up to about $9,600 per coin, so more than $9,000. So it's really made a very dramatic recovery. But you can see the volatility is pretty insane. So a lot of people are now investing in Bitcoin following the initial plummet after COVID-19 because they see it as an asset that's once again not tied to governments and government's fears about the pandemic. Again, Bitcoin has a warning about its own volatility on its website. So I'll just read that for you because this is coming from Bitcoin's, of course, Bitcoin doesn't have it's a decentralized ledger, but they do have a website, and a lot of people who are involved in it have, participate in maintaining the website. So this comes from them. The price of a Bitcoin can unpredictably increase or decrease over a short period of time due to its young economy, novel nature, and sometimes illiquid markets. Consequently, keeping your savings with Bitcoin is not recommended at this point. Bitcoin should be seen like a high-risk asset, and you should never store money that you cannot afford to lose with Bitcoin. If you receive payments with Bitcoin, many service providers can convert them to your local currency. So this is straight from the horse's mouth. So even they are, very cognizant of their own volatility here. There's also what I call the Quadriga problem, or a problem of lack of accountability. So Quadriga is a Canadian cryptocurrency exchange, and it was founded by that gentleman in the picture there, Gerald Cotton. So he didn't found a cryptocurrency itself. He didn't make like a competitor to Bitcoin, but he founded an exchange in Canada that was one of the most popular ones where people could exchange cryptocurrency with one another. So he created this system, Quadriga, this exchange. But he suddenly died in December 2017. He died while he was traveling abroad with his new wife on their honeymoon. He was in India. He died very suddenly in December 2017. And at that time, it was reported that at least 195 million in US dollars became immediately inaccessible to investors. It was located in cold storage, and we'll talk more about what cold storage is soon, on a laptop to which only Cotton knew the passcodes. So the Canadian government became extremely concerned about this. How did this happen? How could one person be, the sole person who had access to all of these funds in this exchange? How could this have occurred? So they actually they required Ernst & Young through court orders to become the auditor for this whole Quadriga issue. Finally, Ernst & Young was able to access the cold storage in mid-2019, and at that time it was revealed that, guess what? Cotton had probably embezzled the vast majority of the money because all those cold wallets were basically empty. The vast majority was gone. That has, as you might imagine, led to a lot of people speculating about whether Cotton is really dead, or is he just, hanging out in the Caribbean waiting for things to die down so that he can use those millions that he apparently embezzled. We may never know. I don't know. It's a mystery, but it does point to issues with accountability and accessibility in cryptocurrency that are a valid concern for many. One more concern that I found when I was looking at Bitcoin's website recently is irreversibility. These are not transactions that can be undone very easily. So again, from Bitcoin's own website, a Bitcoin transaction cannot be reversed. It can only be refunded by the person receiving the funds. This means you should take care to do business with people and organizations you know and trust, or who have an established reputation. So again, this isn't something that can be undone very easily. When Rob sent Laura the cryptocurrency back on a previous slide when we were showing how Bitcoin works, if he changed his mind about it a little bit later, he'd have to rely on Laura to refund him. So if he didn't trust Laura, that probably wouldn't have been a good idea. Okay, so now I'm going to move into the second part of the presentation, which is the intersection of cryptocurrency, blockchain technology, and estate planning. First, I'm going to talk about the treatment of cryptocurrency for tax purposes in general. So in 2014, the IRS sort of first started getting involved in what was going on with cryptocurrency. It published a notice 2014-21, saying that cryptocurrency is treated as property, not fiat currency, for tax purposes. So what that means is that the transfer of cryptocurrency is not like transferring US dollars or any other kind of foreign currency. It's treated as transfer, for example, of something like stocks. So it may result in loss or gain. And I just put the website there if you want to check out the letter to taxpayers that was issued in March 2018, where the IRS basically said, hey, guys, remember that this is treated as property, and so you need to be tracking your basis. A trust that liquidates cryptocurrency. So if a trust holds cryptocurrency and then liquidates the cryptocurrency in order to make distributions to a beneficiary, the trustee should be aware of the potential capital gains or losses to be incurred and passed out to beneficiaries. So we have to think of this for tax purposes more like stock and transfers thereof, rather than transfers of regular fiat currency. The most recent IRS guidance on cryptocurrency came out in a new and very much anticipated revenue ruling that was issued in October 2019, Revenue Ruling 2019-24. The IRS at the same time also published some frequently asked questions related to cryptocurrency, so that's a helpful resource. The newly articulated IRS policy was about hard forks and taxable income. And I'll talk about what exactly those forks are in a minute. But the fact that they published this revenue ruling about hard forks, they published some FAQs, and they also sent out 10,000 letters in October 2019 to taxpayers who they knew were trading in cryptocurrency. All of this together indicates that the IRS is stepping up and intending to take a more active stance towards enforcing tax law with regard to cryptocurrency. So in order to understand this revenue ruling, we have to understand some terminology. So a fork is a cryptocurrency term. It's when one cryptocurrency, such as Bitcoin, is split into two after the existing code creating that cryptocurrency is changed. A hard fork means that the new version of the software, which is the blockchain, right? That's the technology that's driving the creation of the cryptocurrency. The new version of the software is designed to be incompatible with the first. So basically, we're getting rid of the old protocol, we're getting rid of the old blockchain, the old decentralized ledger, and we're coming up with a totally new system. A soft fork is when the new version of the blockchain is designed to be compatible with the first to some degree. An airdrop is when crypto coins are given away to wallets on the chain of users. This occurs either because a fork occurred, so now we no longer have cryptocurrency 1, we have a hard fork, so now we're going to have this whole new cryptocurrency 2. There might be an airdrop then of cryptocurrency 2 into everyone who had an e-wallet containing cryptocurrency 1, because that's the people designing the protocol, that's their recognition that instead of crypto 1, now we're going to have crypto 2. So we're giving you these new coins to kind of get you started on converting everything to the new system. It can also be an initial offering of a new cryptocurrency, so you also get an airdrop of coins if you're buying into a brand new cryptocurrency for the first time. So if a brand new cryptocurrency is coming out, the way that people might receive those initial offerings is through what's called an airdrop. So there's 3 options that happen when a fork occurs, and remember we have the hard forks and the soft forks. So option 1 is one blockchain now becomes dominant so that the other blockchain technology will be underused by the community or reduced in value. So that applies to some hard forks. So the idea then is that the new one is really replacing the old one. It's not meant to come alongside it. The new blockchain is going to be dominant. The other one will be either unavailable completely or extremely underused because it's not going to be very efficient anymore. Option 2 is when both blockchains are used and neither is dominant or more highly valued. Some soft forks are like this. It's just sort of a new currency splitting off from an old one, and both of the ledgers are still going to be utilized. Option 3 is kind of a hybrid. Both blockchains may still be used, but only one of them is going to be favorable. So the other one just might not be quite as easy to use. A lot of people might still stay on it, or they might use both, but it's going to be encouraged to move to the new one. This one is also more common with hard forks than with soft forks. So what did the revenue ruling say? Well, it says that Revenue Ruling 2019-24 says that if a taxpayer owns cryptocurrency that's affected by a hard fork, but the taxpayer receives no additional airdropped units of cryptocurrency as a result of that fork, then the taxpayer does not receive gross income under Code Section 61. So no airdrop, no gross income as a result of the fork. However, the revenue ruling goes on to say that if, as a result of the hard fork, there is an airdrop of new units of cryptocurrency distributed to the taxpayer, so the taxpayer is getting those new units of the new cryptocurrency airdropped into his or her e-wallet, then the new units are going to constitute gross income to the taxpayer under Code Section 61. However, the taxpayer does not realize that income until he or she is actually able to access the new units and exercise dominion and control over them. So a user might see that there's going to be an airdrop of coins, but it hasn't been finalized yet. The income isn't realized until it's actually finalized. Okay. All right, the IRS also, this is a very new development. It just happened on May 12th, so I thought I would include it in here. It's another example of the IRS really indicating its desire and intention to address cryptocurrency for tax purposes more actively. On May 12th, the IRS released a statement of work seeking assistance from various independent consultants, and these are technology and consultants that are involved in blockchain technology and cryptocurrency markets. They want to compare the tax returns of taxpayers who they know have cryptocurrency assets with data that they're going to obtain from these contractors about how these users have been accessing cryptocurrency exchanges. So the indication is clearly to try to compare people's returns to what people are actually doing and making sure that people are reporting the changes, reporting the gains and loss that they may incur from exchanging cryptocurrency on an accurate basis. All right, now we're going to talk about gifting with cryptocurrency. Charitable gifting is a potential opportunity. Since cryptocurrency tends to be pretty volatile, you might have an appreciated asset of cryptocurrency that a donor may want to gift to a charitable organization. In that way, they can avoid the taxes on capital gains and also get an income tax deduction for the donor. The real problem here is that the number of organizations that accept those kinds of donations of cryptocurrency, is still really limited. It includes a lot of kind of cutting edge charitable organizations, a lot of organizations that are involved with technology, like you can see them listed there. Code to Inspire is one of them. It does, however, include the United Way and the American Red Cross, interestingly. So if you have clients who have appreciated cryptocurrency and they're interested in charitable donations, these are some organizations that you can look at. For non-charitable gifts, cryptocurrency is, remember, treated as property, not fiat currency for tax purposes. So tracking the basis is crucial. A donee is going to receive a carryover basis, not a step up in basis. It's important to track this. Remember, the IRS is getting more involved in this, and now they're looking to really track these kinds of things. It's still in the infant stages, but we should be advising our clients to, of course, follow the law and track their basis as they would with other assets, subject to appreciation and depreciation. If a transfer needs to be demonstrated as being irrevocable, if a donor is gifting to an irrevocable trust, for example, you might want to consider having the donor sign an affidavit to that effect, showing that they no longer have control over the cryptocurrency. That's because anybody, and we'll talk about this in another minute, but anybody who has access to like the password on an e-wallet that contains cryptocurrency can transact that cryptocurrency. So there should be some assurance that a donor who has transferred cryptocurrency really has made that transfer and therefore no longer has access to this passcode. In order, it's kind of hard to prove that, which is why an affidavit might be advisable. Some planners might consider irrevocable dynasty trusts or grantor retained annuity trusts, which are good with highly appreciated assets, or GRATs. So those are some possible opportunities. All right, so the next area here is cryptocurrency and estate and trust administration. I just included this fun little cartoon. It's basically just an illustration of what the problem and the advantage and the disadvantage of having cryptocurrency as an estate or trust asset is. And the real advantage and disadvantage is ease of administration by the fiduciary. So in order for example, an executor to gather assets in an estate, a lot of the time it's necessary for example, if the decedent had a bank account, for the executor to call the bank and say, I'm the executor of the estate, this person died, here's my letter of qualification from the court, here's the death certificate, and the bank has its procedures for transferring that account into the estate. With cryptocurrency that is, for example, stored in an e-wallet, no death certificate is necessary, no letter of qualification. Rather, the executor, the personal representative, only needs the decedent's cryptocurrency passcode, which is typically very complex, in order to transact. If he or she has the passcode, then they're free to transfer the cryptocurrency without any further restrictions. So they just use the passcode to access the cryptocurrency and distribute it to the beneficiaries. There's no need for them to make a lot of complicated transactions with the bank or show any verification at all. That is really easy for the personal administrator, but it also it involves a lot of power and freedom for the personal administrator. But that's a double-edged sword, because of course, if you've picked somebody who's not very trustworthy, I think that the problem is pretty clear, as you can see in this cartoon. It's possible that if a personal representative accesses the e-wallet in this way and clears it out, if they're not a trustworthy person, it might not be able to be reversed. Of course, there's legal recourse of breach of fiduciary duty. However, it's still possible that the money itself will be gone. There's also a possible but troubling solution to this problem, which is called cold storage. So I first mentioned this with the Quadriga problem and Gerald Cotton. Cold storage is a method of storing cryptocurrency information where the passcode is stored on what's the equivalent of a USB drive, but it's hidden from other users. Instead, the device privately sends the passcode to allow access to the account, but the user who receives it does not actually have access to the passcode itself. So it's kind of like if I gave you a USB drive and you were able to use it, but you didn't have the password to every file on there. It was just you could use the USB drive, but then I can take the USB drive back, and now you no longer have access to it. Cold storage may be an effective way for successive fiduciaries, so for like a successor trustee, to pass the passcode information along without any of the other trustees knowing the passcode itself. So you don't have to worry about a former trustee still having access to the passcode because he only had access to the cold storage and now he doesn't have the cold storage anymore. However, it's unclear whether the cold storage device itself constitutes tangible personal property under state law. This hasn't really been addressed by states yet, so it's really important to make it clear in the person's estate plan itself how it's to be treated. So if you don't want a cold storage device to be treated as regular tangible personal property that's just going to go to the person's wife or their kids automatically, if you have a more specific plan for that cryptocurrency instead, it's important to specifically exclude cold storage devices from the definition of tangible personal property in the estate plan. Fiduciaries also need to pay careful attention to state laws. Let's see. Sorry about that. Just real quick, fiduciaries also do need to pay careful attention to state laws like Uniform Digital Asset Laws, Uniform Prudent Investor Act, to make sure they don't run afoul of those provisions when they're administering cryptocurrency, because it can be considered a digital asset. So it's just important to take a look at that. Another problem is passcodes. Like I said, if you have the passcode, you can access the account. You don't need the death certificate. You don't need any other authorizations. But the problem is that lost passcodes for crypto accounts are often truly lost. So care has to be taken to ensure that the fiduciary will be able to access the passcode or storage device. When I was talking about Quadriga and Gerald Cotton, the problem was that he had all of these crypto wallets, people's account information stored on a cold storage device. The cold storage device was on his laptop, and he had not shared the password for his laptop with anyone else. So the real problem was that, nobody had the passcode to the laptop, and therefore nobody could access the cold storage device. If he had left that information with somebody, then it would have been accessible. But remember, these things are complex and not easily discovered without a lot of effort, and sometimes they can't be retrieved at all. So it's important to try to figure out the best way for the person who owns the cryptocurrency to communicate that passcode in some way to the next fiduciary. Another issue is diversification. Because of the volatility of cryptocurrency, a requirement to diversify in estate planning documents might be wise. If the grantor of a trust wishes for the trust to hold substantial amounts of cryptocurrency and not be required to diversify, then provisions should be included in those documents, allowing the fiduciary to be relieved from any duty to diversify. And I just included at the bottom here, this was the update on the website of Quadriga, Gerald Cotton's company, the cryptocurrency exchange in Canada, when he died. It basically said we're down for maintenance, nobody can access their stuff, and unfortunately it never really came back. This was the status update permanently after December 2017, until the whole thing was just completely disbanded due to the embezzlement by Gerald Cotton. All right, I just wanted to give a few examples. When I initially gave this talk, it was for a lot of people who were involved in the life insurance industry. So I was trying to show some examples of how blockchain technology is used in that particular industry. Cryptocurrency is a potential investment for life insurance policies. So this is something that's relatively new on the scene. In April 2019, the French government passed a law called PACT, to encourage diversification of investments among retirement, life insurance, and employee stock ownership plans. It allows life insurance providers to invest in cryptocurrencies without any limitation on the amount that can be allocated. It's the first time that such providers have been permitted to invest in cryptocurrencies. Is this possible in the US? Not right now. There's a lot more restrictions on how life insurance companies can invest in the United States. The main concern being the volatility of crypto as opposed to traditional equity markets. But it's happening in Europe, so it's something that could occur in the future. An example of blockchain technology in action is the life insurance claims process. So some people in the life insurance industry have pointed out that there are problems with the current process of filing a claim for life insurance after somebody has passed away. It can be emotionally difficult for beneficiaries who have just lost a loved one. It can be subject to fraudulent claims because a lot of paperwork has to trade hands, often through the mail. It can take a long time. You might have missed a paper the first round, and so the life insurance company comes back and says, hey, we need this and that. So it can take a while. And for decedents who held their cards close to the vest or who had very old policies, there might not even be awareness among beneficiaries of whether a decedent held a life insurance policy in the first place. They might not have any information about that, even if a policy does exist out there. So there's a possible solution through blockchain technology. MetLife in Singapore is working on technology. They've instituted technology called LifeChain. So LifeChain is a blockchain technology that is supposed to assist people with the claims process for life insurance. The nodes in the chain are the publisher of obituaries. So there's a particular newspaper in Singapore that is responsible for publishing most obituaries. Their vital records department there in Singapore. A database research company that's working with MetLife. MetLife itself, of course, also is part of that research company. And then the various beneficiaries and family members. So the way that it works is that they use a public blockchain called Ethereum. They use a public blockchain that's called Ethereum. And when somebody reports, when a loved one of a decedent reports to the newspaper that they want to publish the obituary asks if they would like to share the information about the decedent with the LifeChain workers, and they say this will help you determine if there's a life insurance policy held through MetLife. If there is, it'll help you with the claims. So basically, if the decedent's obituary is placed with that newspaper, they're notified of the LifeChain program. The family can then agree to participate or opt out. If they agree to participate, LifeChain encrypts an identifying number from the death certificate, which is basically the equivalent of our Social Security numbers, with a complex algorithm, uploading it onto the blockchain. They're then able to search MetLife's records to see if that decedent held a policy. If they did, then the beneficiaries, by way of the email address that they provided to LifeChain, immediately get all the claims information, which can then be submitted on the blockchain to avoid security risks. So the potential nodes on the chain, they're hoping to expand this. There could be more potential nodes other than the insurance carrier. Potential nodes or units of information to be provided could be hospitals, funeral homes, other beneficiaries. So it's just something that's out there and is in the realm of possibility for moving to other countries in the future. And finally, I just want to discuss a few recent developments. The Cryptocurrency Act of 2020. This is a federal piece of legislation. It was originally introduced in December 2019, but an updated version was introduced on March 9th, 2020 by U.S. Representative Mark Gozer from Arizona. He was actually in quarantine at that time due to coronavirus exposure. He ended up not having it, but it was from that CPAC conference where people were worried about exposure. The Act authorizes 3 categories of digital assets that are all based on blockchain technology. They're defined as cryptocurrency, crypto commodity, and crypto security. I've included them all here for your review. It's pretty technical. The main purpose of the Act is regulatory. So I received a question before this presentation about the future of regulation in the crypto industry. I think that this is a major concern for our government. You could see that with regard to the IRS and how they're starting to get more involved here in oversight of how crypto is being traded for tax purposes. This act, the Cryptocurrency Act, sets out several agencies that are going to be responsible for regulation of different kinds of crypto assets. So the Financial Crimes Enforcement Network for cryptocurrencies, the SEC for crypto securities, the Commodity Futures Trading Commission for crypto commodities. According to the Act, each federal digital asset regulator will, with respect to digital assets, make available to the public and keep current a list of all the certifications and registrations required to create or trade in digital assets. So they're trying to create a system of regulation here. As I mentioned before, the Bitcoin and other cryptocurrencies took kind of a nosedive when COVID-19 first became more widespread in March, and then went right back up. So in this little diagram here, that really low spot on the on the graph indicates March 2020, when Bitcoin dropped in price by half. It went from 10,000 in February to 5,000 in March, but it's gone back up. The cryptocurrencies, basically, these markets are still volatile and speculative. So when crypto hit and people were worried, the price plummeted. Now it's going back up, kind of for reasons of being more independent from fiat currency. Some people are worried about investing in traditional markets during this time. So that's why the price is probably going back up now, and it's almost back to where it was in February. I've also been seeing online some ways in which people are saying blockchain technology use might increase in the wake of the pandemic. Of course, right now, there have been, ever since the coronavirus started being discussed in January, people were talking about how dirty and full of germs traditional cash is. So we've been encouraged to use systems like PayPal for making payments online, digital payments instead of using cash, and that's probably only going to become more widespread. A lot of those are powered by blockchain technology, so we're expected to see an increase in that. Management of supply chains. So we saw a massive disruption of supply chains in the beginning of the pandemic, especially with regard to medical equipment, necessities like cleaning products that the shelves have been emptied of for months. I don't really totally understand how this works. It's technology that's definitely above my head, but apparently utilizing blockchain technology can help supply chains respond more nimbly and quickly to these kinds of unexpected events to avoid the lack of supply that we saw in the wake of the pandemic. So it's possible that we'll see more use of that in the future to regulate supply chains. Finally, there's been a lot of talk about using blockchain technology for contact tracing for COVID-19. I think this has been employed in countries like Singapore already. Finally, I've seen some articles about voting with blockchain. Of course, a lot of people are concerned about voting during the pandemic, voting in person. Should we have mail-in? Electronic voting utilizing blockchain technology to verify identity has been under consideration. On April 30th of this year, actually, the Senate Permanent Subcommittee on Investigations considered if this would be a possibility, utilizing blockchain technology to promote electronic voting and to allow senators to vote in absentia due to COVID-19 concerns. It didn't really get off the ground, but a lot of people were supporting it. Former presidential hopeful Andrew Yang has suggested publicly that blockchain technology might be able to make for more secure voting. He suggested that when he was on the campaign trail. However, there's a lot of concerns that this technology is just not ready yet, especially for a presidential election in November. An app was created last year called the Votes app, with that creative spelling there. It has tons of problems. The New York Times actually came out in, let me see, I think it was January. Yeah, they came out in February saying that this app was a total disaster and was subject to all kinds of malware attacks and stuff. So I don't think it's going to be happening anytime soon, but it is a possibility for the future. And finally, at the end, I did receive a couple of questions in advance. One of them was about the future of regulation of blockchain technology, which I addressed. Another one was this question, great question. Currently, it appears that the securities industry, namely broker-dealers, are reticent to allow retail investors to purchase securities tied to cryptocurrency, whether they are exchange-traded funds, known as ETFs, or the individual company stocks themselves. Do you see that changing anytime soon? What do you think drives the concern in the securities industry over cryptocurrency? So I touched on this a bit with regard to the future of regulation in this industry. But beyond that, I did consult with one of our corporate attorneys just to get some more information to be able to address this question well. He said, my strong suspicion, not based on actual knowledge, is that broker-dealers struggle with making suitability determinations for their clients when looking at cryptocurrency products. That's because these are new and volatile products, and Bitcoin itself has said, you know, it should be treated as a high-risk asset. So I think that that leads to discomfort for a lot of people in the industry. He also said both the SEC and the Financial Industry Regulatory Authority seem to be uncomfortable with many types of cryptocurrency assets. And the SEC has refused as recently as February to approve any ETFs, exchange traded funds that are indexed to cryptocurrency, because they just tend to be very uncomfortable with these kind of volatile assets. As for whether that will change, this attorney's guess is that broker-dealers may come around when and if the SEC and FINRA seem to be more comfortable with some cryptocurrency products like the ETFs that we were talking about. One of the SEC's commissioners, whose name is Hester Pierce, she's been called the crypto mom by a lot of people in the industry. She's a big proponent of cryptocurrency and crypto-related products. And she actually wrote a pretty stringent dissent from the SEC's decision in February of this year not to allow Bitcoin or other cryptocurrency ETFs at this time. She believes that the SEC is kind of unreasonably against cryptocurrency and that they need to get more involved. So yes, it's possible that it will probably be a gradual change over time as people in the government become more comfortable with this asset. Okay. Unfortunately, I had a lot to talk about today, so I really don't have time to answer questions live. However, if you have submitted a question, don't worry, I will reach out to you individually to follow up on your question. Thank you so much for joining me today, and please look for an email from us at Williams-Mullen that will contain a link to the presentation slides. Also, please do feel free to contact me if you have any additional questions or want to make a suggestion for future topics for our webinars. So thank you so much for joining me today. I do hope that was helpful, and I will reach out to individual question askers after the presentation. Thank you.